These companies are, because they don't think their older managers are producing, they're hiring younger managers who
are willing to be more and more aggressive in what they're doing. In fact,
riskier.
Yeah, risky. Well, they like to say aggressive. That's that's the euphemism for risky is aggressive. Or high yield. That's another one for junk bonds. You know.
Junk bonds, right?
So yes, and the managers are becoming younger. Many of them were in high school during the '87 crash. So that's one of the new dangers.
Well, now let me ask another question here. Mutual funds are diversified to deal with risk.
Neil, I'd like you to answer this one. Let's nail you on this. I mean, now no other statement on this carries the connotation of safety like this one, because you hear it's diversified, so you have to be safe. Neil?
When we give seminars, I always ask the question, I ask the people to raise their hand if they think that diversification is a bad thing, and no hands ever go up. And then I say, well, would you please raise your hand if you think diversification is a good thing? And all the hands go up. And then I say to them, well, it's August 1987. Mm-hmm. How would you like to have a broadly diversified list of common stocks at that particular time? If so, please raise your hand. And everybody understands that the crash came shortly thereafter, so no hands go up. So it's not a matter of whether diversification is positive or negative. It's neither. It depends on what period you're talking about. At a market bottom, diversification is fine. At a market top, diversification is the last thing you'd want to have because you're guaranteed the market result. And if the market is going to have a substantial decline, you obviously don't want that. So the question is simply, what is the market going to do? When people talk about what mutual funds have done, what they're really talking about is what the stock market in general has done. But there are things I'd like to point out. First of all, and we can't argue with some of these things if we're just adults, there is no free lunch. Markets go from one extreme to the other. And if we made it through 9th grade science, we know that for every action, there's an equal and opposite reaction. The action has been from 800 in the Dow Jones averages to 7,000 in the Dow Jones averages. I wonder what an equal and opposite reaction would mean to investors.
I shudder to think.
And also, I bought you lunch today, so how could you say there's no free lunch? I don't understand.
Only if you're exploiting the ignorance of others.
Okay.
Okay, Don.
This is to Don.
Yeah. But I got my fund, a mutual fund, at a bank, at my bank. I've been dealing with my bank for 30 years.
Oh, well, that's one of the... banks used to sell mutual funds, or what was called investment trusts at the time, in the 1920s. And they were very popular. Almost half of the funds at that time were sold at banks. In the 1930s, when people were decimated by what had happened in the crash and into the Depression, the government put banks out of the fund selling business, because people who went into the bank said, oh, I couldn't tell the difference between what the savings product was and what this investment product was. So rather than getting more and more people involved in something they didn't understand, the government said, okay, banks can't sell this anymore. Well, in the late 80s, early 90s, the government, in its role of deregulation, said, okay, banks can sell mutual funds again. And the first things they sold were bond funds, as if, you might remember the advertising line, alternatives to CDs. Remember that one? People took their money out of CDs, put them into bond funds, calling themselves government securities and all kinds of...
It was an alternative.
It was an alternative. It was an alternative. Just that, I guess the alternative was that you're supposed to lose money instead of your crumbing forward.
In 1994, if I'm not mistaken, the bond market was down 30%.
Well, something like that, and some were even worse than that.
And at one point, it was down 30% in 1994.
And 50% of the people who put their money into bond funds, who greeted that 1994 decline, put it in the previous 2 years, because they had seen how great people had done over the previous 10 years. They threw the money in there, and there you are. Now, there is no particular reason why mutual funds bought at a bank are any safer or necessarily any riskier.
You have a large percentage of people that buy it that way, even though they're told, oh, it's not any different. There's that intrinsic feeling that you do feel you're much safer there.
There's one thing you should remember is that Mutual funds bought at a bank are not insured by the government in the same way your bank account is. Right. Simply, that's the most important thing to remember.
Just tell people that, you know, all of you watching may understand all this, and maybe you don't understand all of it. But I'd like to recommend Don's book, and that'll help, won't it?
Yes, this book by Don Christensen, Surviving the Coming Mutual Fund Crisis. And it is selling a lot of books over the country, and we want you to have a copy of this book. If you're involved in investments in any way, you really ought to get this. For a $25 contribution to Cornerstone Television, we'd like to send you one of these as our thanks. You can use this 800 number with your credit card right now, Visa or MasterCard, 1-800-820-4808. There it is on the screen, 1-800-820-4808. And you can say, I'd like the book on the mutual fund crisis, Surviving the Coming Mutual Fund Crisis. And Don tells you how to do it. It's got a lot of very helpful information. And I predict, as you read it, you're going to have somebody else to read it too, guaranteed.
Can I make a comment about the book?
Yeah, you give it to all your clients.
Well, that's what I was going to say. That book impressed me enough because I remember all of the things that Don was talking about. I mean, how many people remember the Mates Fund, Fred Mates? But the book impressed me so much as I studied it and remembered the history of what we'd gone through back in the 60s that we ordered it and sent it out to all of our clients. And it's the only book that we've ever done that with.
How about that? There you are, folks. If you're involved in investments whatsoever, you ought to have this book, okay, for a $25 gift to Cornerstone Television. 1-800-820-4808. Use your Visa or your MasterCard. We're going to be right back after this break as we share it with you about the seminars coming up.
Are you aware of the risks involved with your mutual funds? If not, plan to attend the free seminar, Surviving the Coming Mutual Fund Crisis, on March 7th and 8th. Cornerstone Television, in cooperation with the Impact Network, is bringing these popular workshops to Pittsburgh. Two of the nation's leading financial experts, Neil Jordan and Ron Stiller, will be here to instruct you. To register or for more information, call toll-free 1-888-467-2284. Seminars will be held at the Palace Inn in Monroeville on March 7th, and the Holiday Inn Green Tree and the Sheraton Pittsburgh North on March 8th. This popular workshop exposes the risks behind the mutual fund phenomenon and will alert you to inherent dangers unknown to most investors. Learn how to take defensive measures to protect your money without sacrificing the benefits of a successful investment program. Call and register now.
All right, welcome back. And I have a question now for Neil Jordan.
Well, wait a minute. Before that, I want to make sure people know they're invited to the seminars.
Thanks, Mom. I'm just kidding.
Well, you know, people watch a program like this, it just whets their appetite. They want to learn more, and it's free, and it's available, so why not go?
Yeah, it is frustrating on a program like this because there's so much information that we want to give. Even this list that we're going through, really, we could spend 2 hours just going point by point and explaining all the details behind it so folks can understand. So I want to encourage folks, if you can, get out to one of these free workshops here next week, and we promise you'll enjoy it. We've had great response to the last few that we've run here.
It's been something. Well, I want to ask one more question here, and then, Ron, you can ask the rest of them, okay?
All right.
But again, I'm this Mr. Average Investor, and Neil, I have a question for you. An objection, really. Now, I know the market's high, record high, right? As of almost as we're speaking, I guess. Isn't it? It's close anyhow. And there will be a correction. It will go down some, but the market always recovers, right, Neil?
Well, Russ, I came into the business in 1966, and we were at 1,000 in the Dow Jones averages the day I became a stockbroker many years ago.
That was a record, wasn't it?
That was the first time that the Dow Jones averages had ever been to that level. 9 years later, as the market went through a period of adjustment, a very natural result, a very natural response to the bull market that had lasted from 1942 until 1966, the market adjusted. It took almost 9 years to get to the point where that adjustment had been completed, and that was culminated at the Watergate bottom, and the New York Stock Exchange stocks at the Watergate bottom were worth, the average stock on the New York Stock Exchange was worth 15% of what it had been worth at the top in 66, 68, around that time of the mutual fund popularity.
85% loss.
They were down 85%.
A lot of money was lost.
So long-term investing is fine if the long-term trend is going to be positive. Our expectation is that we have a period ahead of us that's going to be a very high potential period, but a cyclical period with a negative bias for some time ahead of us.
Well, Don, let me hit you with the next one, and it's right on line with this. Is that, well, every decline, Don, is a buying opportunity, right? I mean, when it goes down, I mean, that's when you're going to make some money.
Well, every decline, how deep does it go down? I mean, in the 60s, I believe that the decline, there was a decline from the 1,000, then we went down, then it went up a little bit, then it went down, and went down further and further. It didn't really reach 1,100 until about 1982, wasn't it?
Exactly.
From 1968 to 82, it touched 1,000 a few times, but do you want to tie up your money that length of time? 1925 was even longer. The high of 1925 was not matched again until 25 years later. Yeah. So, you know,
I think a lot of people, they're set on, well, I saw what happened in 87, and the only folks that lost there are the ones that got out. If you would have just stuck in or got in then.
There was an equal market crash in 1962, and people thought the same thing. So when there was a decline started in 1969, people said, oh, look how much money everyone made by jumping on the decline in 62. And 1969 was the biggest influx of money into mutual funds in mutual fund history. But then people started pulling money out during the 70s, and the amount of money that went into mutual funds in 1969 was not matched again until 1981. It was a negative outflow of money for 11 years.
All right, now, Dawn, I'm going to ask you and Neil to comment on this. You talked about influx of money. Mm-hmm. And, of course, we know that money coming into the market is one of the things that will drive it and sustain it at times. So what we're hearing now, a very dangerous statement, is because of the baby boom, we're the largest demographic segment of the population, and they're dumping tons of money into 401ks, and they're just not going to stop. With all these 401k contributions coming in, the market will just keep flying up. Well, so we're safe now. It's not going to be like in the past this time.
Well,
right?
They said that in the 60s as well. Of course, in the 60s, you may remember that...
Well, it wasn't 401ks, it was...
No, it was another complicated product at the time called contractual plans. At that time, mutual funds were sold mostly by door-to-door salesmen selling contractual plans, almost like an insurance policy, where you would commit to 10 years of equal amounts of money being sent in either monthly or quarterly for a 10-year period, and that was your contract. You said, okay, I promise to send in, let's say $12,000, $1,000 a year. And in 1960, there were 13% of all mutual fund shareholders were in these contractual plans. In 1969, 40% of all mutual fund shareholders were in contractual plans, and that was proof that the market was going to stay up.
Right, because the money would just keep coming in, supposedly.
But then in the 1960s, those old enough may remember that there was a great boom time, and they said recessions will never happen. Well, a recession came in the 70s. It was so severe that the people who lost their jobs took their money out of these mutual funds, despite the penalties involved, just to keep up with debt and to have their lives. And by the end of the 70s, contractual plans were non-existent.
Now, this statement coming from the brokerage community and the industry itself, and it makes a lot of sense if you're just looking from a microcosm, from right now, but it doesn't take into account reality of not market cycles, but business cycles, because a business cycle would explain to how a business cycle could ruin this whole market cycle.
Well,
based on the fact that 401k money will keep coming in.
You have a recession, and people start losing their jobs. You won't have the contribution going into mutual funds. And I see this great debt that's going on now, this credit card debt, as a way that people are putting money into mutual funds and taking on greater and greater debt. When that debt comes due, and we know at some time this can't keep on going like this, when a recession comes along, they're going to be taking some of that money that's handy in their 401ks and cashing it in no matter what
we're always going to have business cycles. We're going to have times where the economy is doing well and times when it's not doing so well.
I guarantee there'll be a recession.
All right, so when we hit
I don't know the date, but I guarantee it.
I know the date.
Oh, you know the date. Oh.
In the 60s, he's kidding. In the 60s.
That's tomorrow night.
Yeah. There was a lot of talk that we had inflation licked and we've got this economy in order, and that's not going to happen, and never again a recession. Of course, that wasn't true. We always think because we have more knowledge that we're smarter. Again, human nature being human nature, and it's if we go into recession, Don, then what you're saying is, number one, it just totally reverses this theory about the 401k contributions, because there's less jobs, so there's less people putting money in. There's people being laid off who are going to have to take their money out just to live on, and not to mention the fact that if that is the cause of the stopping of the market and decline, and people start shifting their money out of equities into money markets, then that's a triple hit against the marketplace. So we're not going to see this continual rise here. Let's go into the next dangerous statement. Neil, I'd like you to address that. Investors are much more sophisticated now, and they're not going to, if there's a decline, studies show they won't pull out. Now, Neil, you've been studying investor psychology for 30 years. What do you feel about that statement?
Well, first of all, they have already been pulling out. We have a study from the Investment Company Institute that shows what the S&P index has done and what mutual fund shareholders have done. It shows the money flow into the market and out of the market from the hands of shareholders. And the statistic is that the mutual fund shareholders have actually done about a third as well as the market has done, because of their willingness to exit at times like the '87 bottom, the time of the crash, like the Gulf crisis in '90 and Orange County in 1994. There is nothing new from the standpoint of investor response to media influences and the emotions of the day.
What happened July of '96?
Money stopped flowing into the mutual funds.
Why?
Well, people saw the market declining. There's nothing new. You know, markets move both directions. It's an emotional medium. Investors are going to be doing the wrong thing most of the time in an emotional environment. That's why you have great buying opportunities at those bear market bottoms, which are our focus. That's why you have the opportunity to sell near a top, because people get all excited. Think back just a month ago, everybody gets all excited about the stock market after it's been rising for 15 years. I saw a fellow on CNBC make the statement that the thing that would keep the market moving up was multiple expansion. We are already at a point where price earnings multiples are at historically high levels, and they're related to historically high earnings. So if Don's right, and at some point there's a recession, what do? You get lower earnings, and coupled with that, you also get lower multiples. So if you go from...
Wait, now, what that means, Norma,
Right.
is that
I'm wondering.
as everybody's been in love with the market,
Right.
and they've been doing well, the extreme could be the opposite could be just as extreme, and faster.
Right now we're at about 22 times the earnings on the S&P, which are record high earnings, and that's a record high multiple.
Don, did you want to comment on this?
You know, last summer when people started taking money out of the market, and the decline wasn't even 10%, I don't think. That was nothing compared to what people experienced in the 70s, when they would see the value, as they saw the value of their holdings drop 20%, 30%, 40%, 60%, 70%. Then the media attention changed, and they instead of saying just send your money in, then they said, oh, you better, if you send more in, that's like sending good money after bad, or cut your losses now, because when you go down 40 or 50%, so I better take what I can so I don't go down 70%. And at the time, in the 70s, the concept of dollar cost averaging was never mentioned. That was really
Well, I want to make one more comment. I would say perhaps the most disciplined people in the world are the Japanese. They said they will never walk away from the
they're
market.
not selfish like the Americans. They'll work as a group, right?
What about it?
Well, yeah, we know what happened in Japan from the standpoint of people exiting that market, but I have a story I can tell you also about what happened in 1987. This was communicated to me, which was that some major, big-time Japanese investors walked into one of the major brokerage firms on Wall Street. This was in August of 1987, and they said, can you show us a list of your 100 favorite stocks? And they got out their list, and they said, okay, buy us 100,000 shares of each one. And that was literally days before the peak of the market in '87, just before the crash. So don't think that those people are particularly experienced and unemotional and objective.
And when the stock market started to tank in Japan, the Japanese, for all their reputation, they took their money out.
That was another market that could never go down.
That's what they
It's
said.
down 2/3 from its peak.
Russ, before we go to break, I just would like to mention one thing. For those of you who can't make the workshops and this information is frustrating you and you would like some more information, the number they keep running on the screen, the Impact toll-free number, 888-467-2284, which is 888-IMPACT-4. If you can't make it to a workshop and you'd like us to get you some information, please feel free to give us a call. We'll get you the information free of charge. Just call us and give us the proper information and we'll get it back to you. And we promise that we're on a crusade to educate here. So give us a call and we'll get you the information if you can't make it to the workshop.
Okay, this is Don Christensen's book, The Surviving the Coming Mutual Fund Crisis. We want to tell you how you can get your copy of this very informative book.
For your gift of $25 or more to help Cornerstone Television continue broadcasting the gospel of Jesus Christ, we'll send you the explosive book, Surviving the Coming Mutual Fund Crisis by Donald Christensen, one of today's most outspoken and highly accurate financial experts. Surviving the Coming Mutual Fund Crisis shows you how you can take control of your own financial destiny and not become a victim of the next financial disaster. New high-risk investment policies are radically changing the way mutual funds invest your money. Find out how to enjoy the mutual fund boom now and discover the defensive measures you can take to protect your money for the future. Thousands of investors have already benefited from Don Christensen's crucial advice. Now you too can find out what to expect and what to do. Discover what will be the investment bombshells of the future. Where are the risks and opportunities in money market, bond, and stock funds? How do you identify a dangerous fund? How safe are the funds in your 401k retirement plan? Are there better and safer places than mutual funds for your money? These are just some of the critical questions that Don Christensen answers as he provides you with indispensable mutual fund advice. Plus, as a free gift, you'll receive an intriguing booklet featuring the razor-sharp insights of Neil Jordan, the top money manager in the country, giving you an insider's look at recent market cycles. This valuable booklet is not available in bookstores. Call right now to order Don Christensen's Surviving the Coming Mutual Fund Crisis, or send your check to Cornerstone Television, Wall, Pennsylvania, 15148-1499. You need the book that dares to tell the truth about mutual funds, with financial counsel you can't afford to ignore. Call now.
Are you aware of the risks involved with your mutual funds? If not, plan to attend the free seminar, Surviving the Coming Mutual Fund Crisis, on March 7th and 8th. Cornerstone Television, in cooperation with the Impact Network, is bringing these popular workshops to Pittsburgh. Two of the nation's leading financial experts, Neil Jordan and Ron Stiller, will be here to instruct you. To register or for more information, call toll-free 1-888-467-2284. Seminars will be held at the Palace Inn in Monroeville on March 7th and the Holiday Inn Green Tree and the Sheraton Pittsburgh North on March 8th. This popular workshop exposes the risks behind the mutual fund phenomenon and will alert you to inherent dangers unknown to most investors. Learn how to take defensive measures to protect your money without sacrificing the benefits of a successful investment program. Call and register now.
Well, here we are again talking about these seminars that sound so exciting to me. And they're in Pennsylvania. They're in Green Tree, they're in Monroeville, and they're for you if you want to come. And they're free, right?
Right.
And, you know, ladies, why don't you get another friend and come to the seminar? I know we're just as bright as the men, but sometimes we have more time to do these things, and we can educate our friends, our husbands, whatever. Is that a good idea?
Yeah, and I'd like to remind everybody one last time, not only are we speaking next week at a series of workshops around Pittsburgh, Pennsylvania, but the week after that, Dawn and Neil and I will be in Orlando, Florida at the Sound Money Investors. And anybody who is watching this in Florida who would like to come to the Sound Money Investors seminar, which is tremendous educational workshops going on there, Call the 800 number they see on the screen, 800-346-0092. I know we're flooding everybody with a lot of different 800 numbers, but call and tell them they saw the show on Getting Together, and they would like a discount. Yeah, and they will be awarded a discount to get into this workshop, which is right by the airport at Orlando.
Easy to get to. Maybe even
if you know your way around
from
Orlando.
other parts. Right, well, I mean, from other parts of the country.
Yeah.
You know, people like to go to Orlando for lots of reasons. Yep. But I wanted to bring up Don Christensen's book, and there's a chapter here, folks, that you're all going to be interested in. It says, Winning Now and Bailing Out in Time. I mean, that sounds like an exciting chapter, right?
Yeah.
Well,
right?
it is an exciting chapter, I guess.
You know.
So I've had
Winning
people,
now and bailing out in time.
Although people worth the price of a whole case of books.
Yeah, you know what? And I want to get some comments on Neil as we come into the tail end of our show about some solutions here. But Dawn, I want you to share a story you shared with us right before the show. Winning now and bailing out. The Investment Company Institute, who is the
Investment Company Institute. This was just revealed to today's newspaper.
Folks, listen to this. If you haven't heard anything else on this program, listen to what Don Christensen has to say. Listen carefully.
The Investment Company Institute is the trade association for the mutual fund industry. And it has 60 members, you know, big mutual fund companies that support this trade association. And they pay dues to the trade association based on the amount of money they have under management. As they have to send in a certain percentage. Well, it was revealed that the Investment Company Institute has been, because last year was a banner year, they have been building up their kitty, as they called it, their kitty, in case the stock market declines so severely, they won't have the income anymore to do their job. So they're building up a kitty so that they can be safe when other people lose their kitty, I guess. But so that it was revealed today that where they are investing this money. Well, they have a three-member investment board.
What size kitty do they have?
$28 million. They have a $28 million kitty, and three people from the mutual fund industry got together and decided where they should put that $28 million. Well, 29% of it they put into money market funds, 59% of it they put it into treasury bills, 12% they put into bond funds, and not one penny went into a stock fund.
Yet you hear all this touting about, look how great the records have been with the stock funds, and, you know, just jump into the market now. You don't want to miss it. Look what everybody has done. You don't want to miss this now.
But the Investment Company Institute itself was not willing to put their money at risk. I mean, this is ultra conservative.
And how do you call $28 million a kitty? That's a cat. That's big.
I want to recap.
Well, when things go bad, they're going to need that kind of kitty for their public relations program.
For the public relations, right. I want to recap what Don Christensen just said. Out of this $28 million that is owned by this organization that represents all of the mutual fund industry, or most of it at least, they have this kitty of $28 million. These are mutual fund companies. 3 of their members were on this committee to decide how to invest it. Did they invest it in mutual funds? You'd think they would invest 100% of it. Well, at least 90% of it in mutual funds. They didn't invest 1 penny in mutual funds.
Well, not in stock funds.
In stock funds.
They did in bond funds.
12% in bond funds.
I'm sorry.
But
only
59% in treasury bills.
Really stepping out at that 12% level, aren't they?
So, yeah, that's it. Action speaks
and
louder
actually,
than
one
words.
of the funds that they selected did so poorly, it's being liquidated. And that was the quote in the Wall Street Journal. How many mutual fund managers does it take to pick up mutual funds?
So the people on the inside know something you don't.
They're taking the safe route.
Now you know it. Now you know it.
All right, we got about 5 minutes left. Neil, and I would like you to address that. Now, what we're going to do is ask you the meaning of life in 5 minutes. So, but what are the solutions? Now, obviously, we can only hit it in a very general sense. Now, I'm going to list them, and these are from your earlier teachings. The solutions of protecting yourself, and I'd just like you to comment on those. And let's put them up on the screen first, and then you just run through these. The solutions for protecting yourself is, number 1, protect your investment capital during a declining market. Number 2 would be have cash available during the market bottoms. And number 3, exploit market opportunities. So protect your investment capital during a declining market, have cash available at market bottoms, and exploit market opportunities. These are simple concepts, yet this is not so easy to do for the average person. I think the average person looks at it like, well, I think when it looks like it's going to go bad, I'll just give one simple phone call and I'll do a free switch from my equities into my money market. And it might not be that simple for people, will it?
We're talking about an investment medium where fortunes can be made. The two things that are really important in the market are that the potentials are very great and the difficulty in achieving those potentials are very substantial. The whole world tends to fail. Even with mutual funds and the S&P index doing what they've done, investors haven't done nearly as well as the market. The fact is that it's a completely competitive, high potential environment. Everybody can succeed in a low potential environment, but when you have an investment medium where literally billions of dollars can be made if someone's successful, then it's going to be a lot more difficult.
Well, Neil, you have, again, you tout a record, a personal record of an average of over 20% a year for over 20 years, which is almost unheard of in the industry. And that has come about by protecting money. It's not as easy. Conceptually, it's easy. Just don't get beat up. But it's not as easy for most people because of the emotions you've taught.
Yeah, well, Don talked about how the most money that ever came into the market came in 1969. 69 was the beginning of a great bear market, and the news background was very positive when that money was coming in, but that's what you have at the top. What you need to do is be, it's the old buy low philosophy. I don't think anybody would say that the market today is low.
Well, why is it, Neil, at most great market opportunities, most people don't have the cash?
They might have the cash that they've recently gotten into their hands as they sold out near the bottom, but they don't have the willingness to commit it at the time when the news background is negative.
So what's happening is that people are being taught, don't worry, hang in there, and they see their account going down and down and down to the point, like you said, Don, people could have lost half of their money, and I guess at that point, Don, they're saying, well, thank God I only lost half, I'm getting out, and there someone comes along and say, hey, I know you lost half your money, but this is a great time to get into market, and those are the very things people are missing, you're saying.
It was at that point is when they put it into Treasury bills. After they took out, they only had half of it left.
Yeah.
At a market bottom, what you have is the whole world not deciding this is a great time to be selling. They know that that's not a great time to be selling, but it's a philosophy or a statement and an action by the investor to get things under control, it's quote unquote, get out temporarily and wait and see what happens. And that's what they do. They get out temporarily. They do go back in. They come back in a year later when the news is better, when the market has reconfirmed its strength to them. You've gone from a bear market back into a bull market. They come in a year late. They miss the great opportunity, and they get in when the risks are higher.
And the cycle goes on and on and on.
It perpetuates itself. If it's so easy to be successful, where are all the billionaires? I mean, Warren Buffett and Bill Gates are out there, but Buffett's return, if you understand, he's only done about 23% a year, and he's the second wealthiest guy in the country. What does that tell you about investor success in the stock market?
Right. Now, before we wind up tonight, again, I want to remind everybody, if you'd like to get any information, you're not able to access one of the workshops, and you're watching from anywhere in the country, please feel free to call our number, 888, it's a toll-free number, 888-467-2284. If you're interested in accessing information on surviving the coming mutual fund crisis or information on Neil Jordan himself, give us a call, let us know specifically what you'd like, and we will get it to you.
Okay, we're going to be back tomorrow with Ron and Neil and Don. And remember, you can order, make a gift of $25 to Cornerstone Television, and we'll send you Don's book as our thanks, 1-800-820-4808. That's just for the book. Okay, a $25 gift using your Visa or your MasterCard. And we want you to have this book, Surviving the Coming Mutual Fund Crisis. If you're involved in investments whatsoever, or even thinking about it, you need to read this book.
Tell your friends and neighbors to watch tomorrow.
Indeed. And It's good to have you back with us, Don. Neil, God bless
Always
you.
a lot of fun.
Yeah, that's right. We'll be back
Goes
tomorrow.
too quick.
An audio cassette copy of today's program is available for $7. When you write, please ask for today's program number and send your request to Tapes, CTV, Wall, Pennsylvania, 15148 1499.
Cornerstone Television wishes to thank all our faithful viewers whose consistent prayers and financial support have made this program possible.
Coming on the next Getting Together, join host Russ and Norma Bixler for our special Surviving the Coming Mutual Fund Crisis. Our guests include Ron Stiller, Don Christensen, and Neil Jordan. If you are looking for sound financial advice, tune in on Thursday and Friday, February 27th and 28th on the next edition of Getting Together.